Hello folks, this is Brian Mallory for SharePlanner.com, July 30th, 2010, the last trading session of the month, and boy, what a crazy month it was for trading, to say the least. Started off like we were going to be going down pretty hard, but didn't quite happen. Instead, the bulls put together a pretty nice run, to say the least, off of the lows from June, and never really looked back. Today in particular was quite a bore. Didn't seem like that way at first. You had the GDP report that really drove the futures down pretty hard, and then from there was pretty much all the bulls. They rallied it back up, and then they weren't able to hold their gains. So we basically finished on the S&P 500. We were up 0.01%. So that is just about as flat of a day as you can get. As for me on the trading week, finished up probably about a 0.5%. Gotta tell you, it was a frustrating week for trading, to say the least. I didn't put on any swing trades because the market, one, is overbought. Two, no way I'm going to be putting on any short positions right now because everything seems to be pointing to the bulls having the control of the market in the short term. So until that theory is proved false, I'm not going to be jumping in front of that freight train. So, my most successful trade on the S&P this week was actually fading the gaps. All 5 openings could have been faded this week for decent gains. I tend to risk the same amount regardless if it's a 2-point gap or a 3-point gap or a 10-point gap. It's pretty much all the same amount of gain or loss for me either way. But in any case, I faded 3 of the openings this week, and one of them that I passed up on was a little bit too small. I believe that was Wednesday's, a little bit too small to try to fade. I think it was like a one or 2 point open, so there's not much opportunity there. The other one was today's, when the market was down like 11 or 12 points at the open. I'm not gonna try to fade that, especially when it's being driven by a strong news event like the GDP. Odds were is that the market would have finished lower today, but it didn't. So, anyways, 3 for 3 on the week on the gaps. That was basically where I got all my profits from this week. On each of those trades, I risked about a 0.5% of my capital as far as what I could make or what I could lose. The overall value of the position was much larger, but as far as my win or loss was about a 0.5% of my portfolio. The other trades I made this week was a few on the SPY, SDS, and mainly the others came from TNA and TZA, the small cap 3X ultras, which pretty much I think I broke even and basically just made a profit for the brokers on. So, anyways, let's look at the S&P 500 chart here. I've gone over this a million times, but it doesn't hurt to get a new update. Got the obvious head and shoulders pattern that's been talked about much in the blogosphere. It did break the neckline, but it didn't break it by much when you look at it from the grand scheme of things. After breaking the neckline, in late June, we go on this nice rally here from the bulls where we put in higher lows and higher highs, which is never a good thing if you're short on the market, which is the reason why I am not that anymore. I'm 100% cash as we speak, and I know I put in my trading plan today. I was actually looking at buying a couple of stocks today, but that never happened. But come Monday, I actually may buy a couple of long positions. It wouldn't be bad to be on the side of Obama and the plunge protection team, since they keep seeming to find ways to artificially pump this market up. So I'll get on their side for once, I guess. I feel like I'm always fighting the government and the SEC and the Fed and all their crazy antics to keep this market going as high as it has. So that may actually come to fruition on Monday for me. Long positions for the first time in quite a long time. But the one thing that does concern me from a long-term or from a bullish perspective is this 200-day moving average, and 3 attempts this week to try to break it, and each time it failed. So, got to tell you, the bulls have got to be able to break through that and hold that and build upon that milestone. Until it does, I'm a little bit cautious about any trades to the long side. But you have this long-term trend line, or not long-term trend line, but this bullish trend line here that started in June and has been very nicely defined here, where you have the bulls bouncing off of it multiple times, and it bounced again today. And that is probably one of the big things that is getting me somewhat bullish on this market here, to where I've got a very definable risk-reward opportunity here. I would be very nervous if we broke below this candle right here, which would basically throw the market into to where it has no direction even in the short term, much less the long term. But if it breaks below that, I would get out of my long position. So those are the things that I'm really looking at right now. Pull up the T2108 because that's a popular chart as well. As you can see, we are definitely in overbought territory, but as you can see from a historical perspective, that really doesn't play much into things, because once it gets into this range, it can stay overbought for quite some time. In fact, if you look over the course since 2008, there's only been 2 times, one here and then one here, where we didn't spend an extended amount of time in the overbought category. And even in this time zone here, we spent a good 60% of the month, January of 2010, in the overbought range. So we could be here for quite a while. Who knows? I don't know. This market has me throwing up my hands right now, because in terms of direction, it's very difficult. But like I said before, I give the slight edge to the bulls, and so sometimes all you need is the slight edge. So with that said, I'm going to wrap things up here. I'm going to go grab some pizza and spend some time with the family, and I hope you guys can do the same. I hope you all enjoy your weekend, and God bless.